Hello, hi, good morning, or good afternoon. This is Brad Renard. Thank you for joining me for this presentation. If you have any questions for me, just go ahead and use the question pane and you can send me a question. I'll be watching it. And I believe, let me just make sure you guys can see my screen. I think you can. Okay, so I'll go ahead and get started here. So I'm Brad Renard. I'm with the chief publisher of Upside Options. And again, thank you for joining me. So I'm going to cover a broad market update. Let's look at the charts. Let's see what the charts are telling us. Is this market expensive? We'll just kind of go through all of the big picture. We'll look at different strategies, what can work and might not work for the first half of 2021. And then I'll give an update on the sector rotation ETF strategy that we have. It's called Global Sector Rotation ETF. We have one called Opportunity Fund, and then our Pinnacle strategy. Okay, so the questions that I'm going to address during this presentation are the following. Major indexes have been taking out higher highs, but recently we had a strong down day yesterday. Is this market going higher or is a correction coming? How expensive is this market? Can it get more expensive? If this market continues to pull back, where will it find support? What will be the best investment styles for the first half of 2021? Such as buying indexes, ETFs, stock picking, covered calls, dividend paying stocks, non-directional trading strategies, active trading versus passive trading or investing, bargain hunting, or buy the breakouts. Should I sell some of my passive ETFs and stocks? Should I add some short exposure or hedges to my portfolio? What will outperform in 2021? Value, growth, defensive, technology, commodities, smalls, mid caps, large caps, emerging markets, Asia, Europe, Latin America. So I have some opinions on just about all of that. Should I buy bond funds? And I'll give an overview of the Global Sector Rotation ETF, Opportunity One, and Iron Condor Pinnacle. Okay, so I have just a couple minutes of about me and about the company, so you know who you're listening to. And then I'll jump into all the slides. All right, just checking to see if there are any questions coming in. Okay, so I'm the chief publisher of Upside Options. I founded this company along with a few other companies back in 2004, mostly publications. These are investment publications. It's a non-registered investment publication. I am the Chief Investment Officer for QTR Capital Management. This is a registered advisory firm and we are licensed under QTR Capital Management. I'm an adjunct professor at Chapman University, Argyros School of Business and Economics, and I focus on management science, statistics, econometrics, and analytics. So that's kind of just part-time. I try to teach one class a semester. I was in high tech for 20 plus years in Silicon Valley. Got started as an electrical engineer at the GE Space Division. That was in New Jersey. And I jumped to lots of different companies, mostly in the Bay Area and Silicon Valley, in marketing, sales, VP of sales. I co-founded a company. One of my largest companies that I worked with initially out of business school was Cadence Design Systems. That's in the Bay Area. That's a software company for chip designers. And then I worked for lots of other small companies. I also lived in Japan for a couple of years running a branch office. My education is in physics, electrical engineering from Columbia, and an MBA from Chicago Booth. The available strategies that we currently have, and this is really on both sides, both Upside Options, that's on the retail side, that's a newsletter. It's easy to use these strategies. You can set up auto trading if you wish, so you don't have to do anything. And then the exact same strategies are offered over at QTR Capital. We just have slightly different names due to regulation, but pretty much they're the same strategies. And that's for clients that have 100,000 or more in a particular strategy, then we would ask them to move over to QTR Capital. So Opportunity One is we buy depressed restaurant, retail, department stores, clothing manufacturers, hotels, casinos, leisure, travel, anything that was hit by COVID-19 and that is still down. A lot of these stocks have already come back, but at least the ones in this list, there's about, I started with 400 stocks, knocked it down to 80. We got 25 in the portfolio. About 6 or 7 of them ran pretty hard already, but they're not done. See, we cycle these. We'll get in, we'll get out, we'll get in, we'll get out. And we're trying to get a 50% gain total for the portfolio in about 12 to 15 months, and then we'll shut it down. So this is just, that's why I call it opportunity one. It's a temporary strategy that takes advantage of the still depressed COVID stocks. Global Sector Rotation ETF. This one is a good substitute for just holding the indexes. And holding indexes is getting more risky right now. So this one is actively managed, and we draw from 90 industry sectors and country ETFs around the world, and we create a diversified portfolio. And so about 30%, 35% is outside of the US, and the US is very expensive. So it's good to diversify elsewhere and not keep everything in the US. Big cap growth, just like it is, sounds, anything greater than 10 billion in market cap, we'll put in that portfolio. Small and mid cap, that's basically 250 million up to 10 billion. Sector rotation growth, now this is stocks, and we're buying the strongest stocks in the strongest industry sectors. Contrarian, and this is really beat up stocks. They've been out of favor for 6 to 12 to 15, even 2 years, and then they're starting to recover. Okay, let me just check, make sure there's no questions. Okay. Iron Condor Pinnacle. That is our trading strategy. That's usually the first strategy everyone wants to talk about. I've been running that one now. I'm the chief trader for that one. I've been doing that one for 18 years, has a lot of track record. So I have toned it down over the years, and now it is appropriate for most accounts. 10, 15 years ago, it wasn't. It was much more aggressive. My clients wanted 50%, 70% a year, 100% a year, but there's no free lunch. So things have to go just right, or things can get a lot more risky. I've toned it down quite a bit, and I'm on my 5th iteration of how I trade it. It's now generating realistically 4, 5, 6% a month. A few months will be 0 or small losses, but currently we're kind of in printing money mode. This is pretty rare. Volatility is elevated still from COVID, and it's allowing us to bring in very high returns each month. So I'm sitting on a 14% return for January already, and this might last through March. We'll see. As long as VIX volatility stays above 20, we are in a very nice situation where we're bringing in very nice premiums for this strategy. And last year we booked 40%. I'll show you the returns. Okay, and then dividend income plus. This is like a bond replacement strategy. Realistically, bonds will give you 3.5%, 4.5% if you're lucky, but there's still risk to it. And this strategy can give you 8%, 9%. And we're doing it by buying blue chip dividend paying stocks like Verizon and AT&T and Chevron and Dow Chemical. They're all paying about 5% dividends. Then we lever it up by 4 times, and then we use half of that cash to open up a two threshold hedge. So you actually have protection against downside, which is nice. So it's protected. Some of it's protected. There's no free lunch. You can't get 100% protection in anything, but there's some protection in there, and we get nice return of about 8%, 9% after fees, after commissions. So think of this as a bond replacement fund, something that can handle larger chunks of one's portfolio that they might have very low risk tolerance for. Okay, so basically 30% less drawdown during corrections and crashes. If the market stays depressed, then the portfolio typically comes back 90 to 100% within 3 to 4 months. And that is very nice. It's very nice to have protection, especially these days. This market's very expensive. Pinnacle, here's Pinnacle returns. This is on the website upsideoptions.net, also on the website qtrcapital.com. 2020 returns, I can't believe that we pulled it off. This was a mess of a year. What a horrible year. I just want to flush the whole year down the toilet from COVID and then all of the mess heading into the election. We pretty much lost half the year. Trying to trade through that market was very difficult, and it took a lot of work, but we got through it. And then the last 2 months, we booked some nice gains, and that last 3 months, and popped it up to a 41% gain. I couldn't believe it. If you could have asked me any time during that year, and I just would have been, wow, if I can make 10% this year, I'll be lucky. That was pretty difficult. So we got through it, and things have definitely calmed down. We just had to get through the election. We got through the election. Things got really much more calm. The president doesn't have a Twitter account anymore. That is very helpful, because that was very difficult for what we do in this strategy, because the market was just moving constantly from Twitter feeds, and things are much better now. All right, differentiation, we're almost done, then I'll jump into all the charts. So for our stock picking strategies and ETFs, actually mostly stocks, we do 4-level quantamental analysis. So we're blending technical, fundamental, and factor-based quantitative analysis. We're long short, mostly long. And we're not really shorting stocks. What we do is we'll just put broad shorts in place. If we start getting signals that this market is starting to head into a very deep correction, pretty good chance we'll get some shorts. Up to 25% of the portfolio will allocate to short trades, basically buying puts on the SPY and other indexes. That's what we do. We follow strict exit rules, so we're able to let most winners run, but we will exit fast enough to lock in gains or any gains that we still have left, and to protect capital. So for example, in 2018, that's a perfect example. At the end of 2018, we're at 75% allocated. We quickly dropped to 15% allocated, because we ended up getting all these exit rules or exit signals for 6, 7 days, 8 days. We ended up finishing 2018 with all these positive gains for our portfolios, and the whole market pulled back really hard. The whole market was down for the whole year in the negative territory, and we were in the positive territory. So we try to move pretty fast on following exit rules and following them as much as we can. You don't want to be too strict on them, but you just want to have very well-defined exit rules to not give all your gains back. 4-level scanner, a couple more slides and we're almost done here. So we do a lot of macro top-level analysis. We're looking at technical breadth, fundamentals, sentiment. We're modulating how much to be bullish and bearish for our portfolios. Then we do a technical scan. We're looking for high probability setups. We have 5 different bullish and bearish setups that we're looking for through our scan. So that's purely technicals. Then we do fundamental screens. I want to make sure for the bullish stocks, and that's mostly what we do. We want to make sure they're very strong fundamentally. Then we do a quantitative screen. That's really the probabilistic information. I'll show you a little more on that. And then we'll do technical triggers to get in and out of stocks. So we allocate about 4 to 5% of capital to each position. So when we say factor-based quantitative analysis, what it is, it's basically math. It's all linear regression analysis. We use econometric statistical mathematics, and it's really what's coming out of this tool. It looks like this. It's a big spreadsheet, and you run like 3,500 stocks through it, or 4,000 stocks, and you get probabilities for all these different setups. And it's basically the probability that a stock will break up or break down through a particular level, and then it gives you some probabilities of how much it would move also, the magnitude of the move. So this requires several years of education in statistics, econometric mathematics, along with a couple, 2 or more years of experience in developing and optimizing models. We're trying to create models that give us predictive significance, and it's very powerful. So it's just one more thing we add to the screening. Okay, let's get into the market. So up to this point, if you have any questions, let me know, please. Okay. So we had the COVID crash. Now this is kind of looking back to 2020, because that was such a disaster of a year. I mean, what a mess. I mean, so January and February, the market was still grinding higher. It was a melt up. It got really expensive at 19.5 times forward earnings. That's really expensive. And then COVID hit starting on February 25th. By the first week of March, we were down 35 to 45%. So in about 3 weeks, we were down. That was just a major crash. So the word I probably use is, violent. It was one of the fastest, deepest, and most violent crashes I've seen in 25, 30 years. It also was not helpful that the market was at an all-time high. It was expensive. That made it even uglier. So then the highly desirable stocks were rebounding by July. They started breaking out into new highs in July and August. The ultra cap stocks, the Apples, the Microsofts, the Amazons, they kind of hit their all-time highs, and then they started taking out all-time highs. And that pulled up all the indexes. So now kind of looking just in the last couple of months, through the end of last year, the SPX has been continuing to grind higher. That's the S&P 500 index. It's trading around 23 times earnings, maybe 22.7. Today we had a rebound. Was getting as high as 23.5 times earnings. That is expensive. I have never seen this before. The highest I've seen so far is 21 times forward earnings, and that was back in 1999, 2000, before the dot-com crash. So Qs, NASDAQ Composite, everything looks overextended. I'm feeling pretty uncomfortable with what I see, and also what I care about is all the different stocks, because I'm looking at 100, 200 stocks a day. We have 100 stocks total in all of our portfolio, so I see breadth. I can see kind of how all the stocks are behaving, and that's what I monitor. That's one of the things I monitor. Back to last year again, just after the crash, so buying some stocks in March and April did well, and we bought large cap. Those are the most stable, been in business the longest with the lowest probability of going bankrupt. That's what I felt comfortable in buying. So we just bought some big cap stocks and filled up our big cap portfolio. But I was really scared of buying anything else. Small caps, mid caps, I was not touching those back last year because I just didn't know how many companies would go bankrupt. So for the big cap, we bought many stocks in March. Chasing the momentum stocks did well since August of last year. They did, no doubt about it. The non-directional Pinnacle strategy, it was difficult. It took a lot of work to navigate through last year. It became optimum finally in June, July, meaning our trades were starting to stick and it was working. By the time we got past the election, it became highly optimum because volatility is still elevated. We had to get past the election. That was just too much volatility heading into the election. And so we would make money and then we'd give it back. And we make some more money, then give it back. And it was just too much work and didn't make too much. Okay, so the operative word for 2020 was patience, patience, patience. For Pinnacle, we booked half of our gains in the last 2 to 3 months. That was it. The rest of the year was very difficult. Half of 2020 was lost. At least for Pinnacle, it's a non-directional strategy. So the market was, melting up in January and February of last year. That's hard for this type of strategy because if it's just moving in one direction, that's hard. I'm constantly moving the trades and pushing them up, 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 up. Then we had the crash. That's hard. So now I have to adjust all those trades down and move them down. And then we started having more of a melt up again and a rebound. So those big moves aren't great for a non-directional strategy. So we can get through it. It just turns into a lot of work for us. But we can get through it. And so we're through it. We got through the election and now it's doing extremely well and it's probably going to be booking, my guess, we'll probably be hitting 10% a month for many months right now. And then once volatility drops, gets back down to kind of normal levels, and as the vaccines are rolled out and we start getting maybe some more, get some herd immunity going on with COVID, then I think volatility start dropping, and then this strategy, the Pinnacle strategy, will probably be closer to 5, 6, 7% a month, 5% a month. That's kind of the target. That's kind of normal. Okay. All right, I just see one question here. Aren't the earnings in the PE ratio artificially low because of force? Okay, all right, I just got a question here. I'm just reading it. It's from Brad. Aren't the earnings in the PE ratio artificially low because of the forced shutdown? Assuming economy opens up, earnings should skyrocket, right? Skyrocket, and this PE isn't so high. Well, okay. The main thing to watch for earnings, or one of the main closely watched earnings indicators, is for the S&P 500 index. All of the rest, it's a little sparse. It's hard to find them. And if you have good sources, let me know because I'm always looking for them. Periodically, I'll see earnings for the, the small caps, but it's pretty sparse. S&P 500, those 500 companies that are followed in the S&P 500 index are very closely followed. I use FactSet as my source. And so I watch it every week, and those earnings are very closely followed, and they're projected looking out 4 quarters at a time, and it's pretty accurate. So right now we're projecting earnings to be $168, $170 worth of earnings, and it's not going to skyrocket. I've heard earnings maybe getting up to 170, 170 or 175 to 178. We're already at 170 right now, and that's over the next 4 quarters. So it's not going to skyrocket. And actually, earnings really weren't killed and hurt that badly for these bigger companies. They were still selling their services and their wares. So earnings kind of fell from 170 down to 150, and then it started rebounding pretty quickly. And I got one slide I'll show you, but no, I mean, yes, there are some companies where earnings have just rocketed. They really have, like semiconductors, semiconductor manufacturing equipment. I mean, when you look at the fundamentals of a lot of those companies, I'm from that industry. I was in the semiconductor industry for many, many years, and especially software that's used to develop the chips. That's what I did. I was in that space for 20 years. And it was always a slow growing industry. And all of a sudden, just in the last couple of years, these industries have just started to explode. So yeah, semiconductors, they've gone up, straight up, and yeah, it's justified. It really is. I mean, earnings growth is amazing. And there are some industries that are specific companies in certain technology industries and cloud and stuff like that are growing fast. So sure, those could climb. They could keep on going higher. Just be careful. Don't chase too many stocks. Be careful in chasing the stocks. But again, I'm looking at S&P 500. We're sitting at about $168 worth of earnings. We'll probably get up to $178 worth of earnings over the next 2 quarters. And that's growth, but it's not massive growth, but it's growth. It is. So is this market expensive? Well, I think so. I think it is. Okay. S&P 500, I started with the weekly chart. So here's just more big picture. This is weekly. I show every bar here represents 1 week of trade. I show the 17-week EMA in red. That's exponential moving average. I show a 43-week EMA in green. A little nugget for you. If you want to have a nice moving averages for a weekly chart, use these, 1743. And you can go ahead and back test. You'll see that's very nice. When the 17 is above the 43 on the weekly chart, it tells you that the stock is in a long-term confirmed uptrend. And it could stay in a long-term confirmed uptrend for many months. So you can go ahead and ride that momentum. If you notice that the 17 is below the 43, be careful. That stock is telling you it's in a long-term confirmed downtrend. Don't fight the trend unless you want to go bearish. You can buy puts on it. You can short if you wish, but that's a bearish trade. Okay, so we can see that the 17 is above the 43. You can see that this chart goes back to 2017. This is a weekly, so it goes back quite far. And you can see kind of a disastrous chart that we've had. Trump got elected back here. The stock market definitely went up about 25, 30%, no doubt. We had a pullback in 2019, late. This was the late December 2018. That was a pretty nasty correction. Took out new highs. I call this the rubber band effect. Usually when it comes down, reasonable probability as long as the economy is doing okay and as long as the Fed has cheap money and interest rates are low, many times it will rubber band and just rebound and break out to new highs, which it did. COVID hit. That was extremely ugly. And here we did it again. Took out new highs. So hey, the market's going to do what it's going to do, whether we agree with it or not. We're sitting at 22 and a half times forward earnings. So this is not sustainable. And anyone says things have changed, things are different. It's different now. I don't agree. It is never different. So I'm already taking into account low interest rates, and I don't think they're going to go any lower. I don't think we're going to go negative like other countries did. So we're expensive. That's where we're at. Okay, so here's the S&P 500 index, major levels. We just got over 3,800, and I'll tell you, we're still probably gonna get up to 3,900. I think we're gonna get up there. Okay, the Dow Jones, same thing, weekly chart, 1743. You can see the 17's above the 43. We're in a long-term confirmed uptrend. We broke up through new highs. A lot of people just pile in. These are momentum traders. There's a lot of momentum people, and that's what I do also. I will buy breakouts, take advantage of momentum. Right now, I am not getting any exit signals for hardly anything. Everything is still staying long, so that's where we're at. This goes way back to where the Trump, won his election. Market went up, got choppy, had that pullback here, and end of 2018 had the COVID crash here. So these charts all kind of look like the same. This one was really ugly, the NYSE composite. Look how it retested where Trump got elected. Trump got elected, I think it came back, it tested this level and then took off. And look at the COVID crash, retested that level. Wow, that was just one ugly crash, but just took out new highs. Now, by the way, we're lucky in the last decade that we are taking out new highs. Back in 1929, that did not work. So if you had all your money in stocks, you lost all your money. So if you were rich, you just went poor, and you were poorer until you died. So because it took 25 years for the market to come back in 1929 after the crash. So recently in the last 10, 15 years, even longer, we have been lucky. Now economists are much smarter. We have many more tools. We're hopefully doing the right things versus back then in 1929 through the 30s, we did all the wrong things economically. So maybe we can keep on buying at the bottom of crashes, but sometimes it doesn't work. In 2008 and 9, it took 4.5 years for that market to come back, and that was ugly. I mean, you pretty much lost half your money if you panicked and sold at the bottom, and that was a long down. That was a long time. That was a pretty nasty 2008, 2009. Okay, IWM, small caps. Look at this chart. So going to 2016 through 2020, Trump election went straight up, sideways and choppy, 2 corrections. Here's COVID, even uglier. Retested the lows from 2016, so that was a really nasty pullback. Finally, the small caps got going and then just shot up and took off. So the momentum players, traders, everyone just piled into small caps. That is not sustainable. That is very overbought, very overextended. So just buying the index, you want to stay away from the indexes. However, stock picking in small and mid caps can work very well. And they can probably work for another 6 months, 9 months to a year. It's just buying this index is not recommended at all. Okay. Here's VIX volatility. That's kind of forward 30-day volatility for the S&P 500 index. You can see yesterday it really popped. This was really one of the first strong down days we had. The S&P was down 2.5%. When you start getting toppy and choppy, this is what can happen. So this could be kind of the first shot across the bow where you'll start seeing a super strong down day, and then you'll see a very strong bounce. This is when you have to be a pretty good chart reader to watch all the charts of certain stocks and certain indexes, because this is when we can start getting toppy, choppy, and start rolling over, because the market is expensive. It's not sustainable. And especially for 200 to 300 stocks that have gone straight up like Tesla, those are not sustainable. So, but we'll get more into some of the charts here. All right, treasuries, this is the 10-year note. We're up at 1.1%. So treasuries, the interest rate on the 10-year treasury is climbing, and it's going to continue to climb probably through the end of this year as COVID is eradicated. So meaning you don't want to be in bonds. You have to be very careful with bonds. Make sure the maturity rates of the bonds are less than 6 months or 3 months, and then that won't be impacted by rising interest rates, but you're not gonna get much. You can get 2.5%, so that's about it. Okay, here's the earnings right here. So this comes from FactSet. If you want to see this, go to type into Google FactSet Earnings Insight, and you'll see the report that comes up each week. It's a very good report. I trust these guys. I've been using their data for, 10 years. And the black line is earnings. This is forward right here, forward 12-month earnings per share for the S&P 500. That's this black line, and it's using this right y-axis. So with the COVID crash, we were kind of near 180 bucks worth of earnings. We dropped to 140. We're up to about 170. Could this get back up to 180? Yeah, it can. It probably will. So probably in the next 6 months, 9 months, we'll see that at 180 bucks worth of earnings. So that will be the denominator when you are calculating PE ratios. So what you would do is basically take what the S&P is trading at. Right now it's at 37.50 divided by 170 bucks worth of earnings right now. That's what we're doing. So S&P 500 companies are now projected to generate about 168 bucks worth of earnings over 4 quarters. Market's trading at, it's a little higher now, about 22.5 times. And market is classified as expensive. So I'm not convinced that anything has changed. Anything over 19.5 times earnings is getting pretty expensive. I think things could easily stay at 19 times earnings, 20 times earnings, more like 19. I think that's, but we'll see. Maybe over the next 5 years, if everything keeps on sticking at higher earnings, PE ratios, then maybe things have changed, but I don't think so. All right, the macro data, I usually show lots of charts, but it's still kind of irrelevant because everything, we have so much dislocations in the market on data. So for payroll, we still have 10 million people out of work. Here's the shock right here, payroll change. So we lost like 20 million and then we just started adding. I think of the 20 million, 23 million that we lost, half of those people are back. The other 20 million or 10 million are still out of work. Unemployment rates kind of in that 6.5% range. This has to be closer to 4 or 3.5 to be classified as full employment. ISM index, that represents manufacturing. Actually, manufacturing is okay. I mean, companies are manufacturing stuff in this country and we're selling it. Maybe a lot of it's being sold online, but they're still selling it. Now, manufacturing is not a huge part of our economy. It's only like 15% of our economy, but it's still a part of our economy. Unemployment, new claims, we still have 700 to 950,000 people a week claiming new unemployment, saying that they were laid off or fired from their job. So not good. Still pretty bad. Retail sales, it's stabilized. People are still spending, but it has weakened a little bit. Non-defense capital goods. So this is really the money that companies spend to buy equipment for the companies, and hey, it's above zero. So it's growing. So we do have growth where companies are buying equipment for their companies. So that's good. So it's just a very uneven market. Some people are doing well, some people are just doing horribly. And hopefully within 6 to 9 months, we'll get through this with the COVID vaccines. Okay, let's look at the worldwide charts. Europe, Germany, emerging markets, China, world. We care about this because it can move our markets. So we just want to make sure that things look stable. And also you can put some money into some of these indexes, and that's what I do. For the global sector rotation ETF, we have Germany in there, we have emerging markets in there, we have China in there. I don't have this one, I don't think I have this one. So, we're looking for breakouts. So look at this chart right here. Here's Germany, EWG. Here's the COVID crash. Germany's coming back. It's trying to get over this level. Make sure you give it many, many weeks because it will fail, and it did. All right, so if you're in it, now you had to retest the 200-day line, and that's fine, but you just had a 10, 15% drawdown. Once it gets back over that breakout, then it starts taking off. So that's usually when we get in. So we're getting around here, it's climbing. Germany looks fine, Europe looks fine. Breakout here, emerging markets look great. Dollar has been getting weaker. So that's good for emerging markets. It's actually good for our companies too. You just don't want the dollar too weak. China broke out, took off. And this is the world less the United States, ACWX. It's good to watch because you want to make sure that worldwide equities, worldwide other economies around the world, mostly developed, but it does have some emerging in there, are doing better, and they are. So that's good. So overall, this is good. I don't see any red flags coming from around the world. That's going to impact the US markets. Okay, daily charts. Here's the S&P 500. This is daily now. Every candlestick is 1 day of trade. First thing you want to do is always draw your horizontal lines, support and resistance. Support and resistance, that's really important. I'm showing the 13-day EMA, that's the red. I show the 50-day EMA, that's the blue. And then I show the 200-day SMA, simple moving average, that's this dotted line. And we can see the S&P broke out above its all-time high around here in mid-November, and then it's been grinding higher. Yesterday was really one of the first heavier down days. I am not getting exit signals yet, but it's kind of like one of the first shots across the bow. So we have to watch these charts pretty carefully. So there's the S&P 500. And then, by the way, for the Pinnacle strategy where I'm selling calls and selling puts on this index, I'm selling calls up here and I sell puts down here. And I just do it over and over and over again. And right now, it's perfect, just absolutely perfect. It's wonderful when volatility is still elevated because it allows us to bring in really nice premium. So when volatility is higher, you want to sell options, not buy them. That's usually the way it goes. So it's perfect right now to sell options, and that's what Pinnacle does. We're selling calls, selling puts. We just do it over and over and over again. The key is you just have to know how to move the trades because you're not going to be right all the time. About 35% of the time we're moving the trades, but that's just part of the business. Dow Jones broke up through, everything looks good. It's just the market's expensive, but looks good. What we care about is a break back below this breakout. If you break back below this breakout, we're coming back down here, down to the 200-day line. So we have to watch that pretty closely. We watch these exit signals for all the stocks that we hold because you start seeing that, you got to really lighten your load, lighten your positions. NYSE, these tend to be more stodgy companies, mostly listed on the New York Stock Exchange, but it's a good indicator because it is a very good indicator. It's more of a leading indicator. I've learned over the last decade of watching this index pretty closely. So it was a really nasty down day yesterday. Now, by the way, some of these charts, most of these charts are from yesterday. Most of these bounced. I did update this one for today. You can see how it was down yesterday and then it bounced today. So this one is up to date. This one is up to date. Down yesterday, bounced today. All the other ones are from yesterday or 2 days ago. I'm sorry. All the other ones are just from yesterday where we had the down day. I did not update it for today. So this one, I'm sure, bounced back a little bit also, NYSE, but it's still over the breakout. That's the first thing you care about. Is it over breakout? Yes, it's over 14,161. It's still over the 50-day line. That's another thing you care about. Or at least near it, trying to find support near the 50-day line. That's good. So it's fine. NASDAQ Composite, again, this is not updated for today, but I'm sure it bounced a little bit up. Looks fine. It looks fine. Qs, these are the 100, mostly technology stocks, no financial stocks in this one. I'm sure it bounced a little bit, looks fine. But here's what doesn't look fine. Okay, this is the weekly of the Qs, and you can see how it just went parabolic. So here's kind of the slope here. Always draw slope lines. I don't show them, but my eyes always look at the slopes. Here's one slope. Then it got steeper through 2019, and then it just kind of started going really steep, almost parabolic in 2020. That is not sustainable. My eye tells me we're coming back down to 265. And if it's just really ugly, this thing could come all the way back down to 234. So this is about an 18% pullback. It could be. It could. I mean, it's not sustainable. That is not sustainable. Same for small caps. This is the daily. Okay, whenever you see the 13 and the 50 and the 200, that's just daily. That's 13 EMA, 50 EMA, 200 EMA. It went straight up. You can see Momentum Trader just piled in. I was one of them. And we take advantage of that. This is an upward sloping trend line that goes way back, like 10 years, and you can see that we're up over that trend line. That usually increases the probability that we're going to run out of juice sometime soon and pull back a little bit. Okay, and I should have showed you the IWM. IWM looks kind of like this. It was just No, actually, I'll show you. I think I got it. It looks different, but it's just crazy. It's just parabolic for the small caps. Okay, market breadth. Boy, I'm going to majorly run out of time here because I got a lot to cover still. Okay, any questions? Nope. Okay, I don't see any questions. Okay, market breadth. If people stripped away and said you can only have a handful of indicators, you can't look at anything else, I would look at market breadth. So this is the cumulative advanced decline line. You can get this in stockcharts.com. Stockcharts.com is a good place for a lot of these types of charts. And it's basically, for this chart, it's basically just adding up from day to day, S&P 500 index. So there's 500 stocks in the index. Every day it takes the 500 stocks and looks at how many advanced versus how many declined for that day. And you get an integer. And you take that integer and you add it to the running total. So every day you just keep on taking the advancers minus decliners, and then you add it to this number and you get this advanced decline line. It's called advanced decline line. Cumulative, right here, cumulative advanced decline line. I put a moving average on it. I got a 17 and a 40 on it. When this thing's climbing, most likely stocks are going higher. And you want, once this 17 breaks below the 43, you can look at some of these indicators down here like a MACD or CCI, but I really rely on this right here. And right now the 17 is still above the 40 on this cumulative advanced decline. And this is for the NASDAQ, which has like 1,900 stocks in it, same thing. And that's incredibly strong. So you can't fight that trend. So you will find stocks that still want to go higher when we see advanced decline line like this. It's just crazy strong right now. All right, high yield versus investment grade. Look at corporate bonds. This is like junk bonds. People are still willing to buy junk bonds. They're feeling comfortable in the risk of default of the companies that issue these bonds. And then for LQD, this is higher grade investment bonds, like the big companies like a Google or a Procter & Gamble will issue. They pay less interest rates because it's higher quality. And what it tells me is that people feel comfortable in the probabilities of default of the company. So everything looks good there. Everything looks good. Okay, you always want to watch kind of market sectors. I use this tool. It's called ETF Replay. ETF Replay, if you want to look it up. But I got several different tools for kind of sector analysis, and it's ranking all the sectors. These are ETFs representing sectors. Here's the rank 1 through 20. Here's the rank over here 21 through 42. PJP is the first top rank. It's pharmaceuticals, and then there's different metrics that are used to create this rank. And return A, I think this is like how much it returned over 3 months. This one's how much it returned over 2 weeks, and then this is if volatility is climbing or dropping. And usually you want volatility to drop if an index is grinding higher. So it's looking at a change in volatility. So we can see that pharmaceuticals is up there, and everything that I checked represents really a broad, advanced leading indicator for economic growth. As the economy is growing, these sectors will grow, and it's a good sign. So what it tells me is that if robotics and automation is way up here, cybersecurity is way up here, retail is way up here, or it's ranked 8, it tells me that the economy is expected to grow over the next 6 to 9 to 12 months. Okay, so that's kind of what I watch for. And then oil is starting to climb. You know, I mean, there's a lot of moving parts of what moves oil prices and oil companies, but it's good to know it's in the top 40 at least. Okay. All right, defensive holdings, gold, silver, the 10-year treasury, consumer staples. XLP is consumer staples here, broke up through. It's a little funky. I mean, it just, everything was climbing, even defensive names. Usually if like high-tech names and really somewhat risky or super fast-growing companies are growing, then people would get out of Clorox or get out of Procter & Gamble. But because of COVID, I think that has changed things right now, and it might last for another year because people were still buying Clorox and still buying Procter & Gamble because of COVID. So defense still looks strong. Yields are climbing, 10-year notes up to 1%. Here's gold, silver. I mean, you don't want to buy gold unless you really get a breakout above one of these levels up here, because this could be dead money for a long, long, long time. Inflation has been under control for a decade. It just doesn't seem like it's moving from globalization and technology. So we'll see. But right now, gold's telling me it's holding over the 200-day line. So sure, it could hold, and could it bounce and start going higher? It could. But if you get a breakout above one of these levels here, then get in. Same thing for silver. Right now I have downward sloping lines, and that tells me that it could be going lower. All right, let's look at some sectors. We care about what the sectors are doing, and then also I throw the sectors into our global sector rotation ETF. So now this is from yesterday. I'm sure all of these bounced a little bit. So industrials, they look fine. Not growing as fast as you would think. I have this one in that portfolio, that global sector rotation ETF portfolio. It's just been kind of lagging. I think it's only up like 2%. It's not much. KBE, banks, you care about what the banks are doing. This is okay. I figured the banks got overbought, hit resistance up here. This is a past resistance level from probably farther back, and then it's selling off. Let these banks come down and retest like 40 bucks, and then I would recommend to get into some of the banks, especially the regional banks. You'll get in at a better price. But the JPMs, JP Morgans and the Citibanks and Bank of America's, of course, the big money centers, they were all doing really well. And let them pull back, take a breather, you can get in at a cheaper price. All right, RYT, equal weighted tech, looks very nice. Just had a down day, it probably bounced a little bit, but that's strong. So technology still doing well. And this is equal weighted, because the other ones, if they're cap weighted, the problem is that Google and Amazon and Apple are so huge that they represent too large of a percentage of these indexes, of these ETFs, like literally 30, 40%. So it doesn't tell me much, but this tells me something because it's equally weighted. And there's probably 100 stocks in here. Semiconductors, as I said, they were really growing fast. All these semiconductor companies, plus the semiconductor manufacturing equipment companies. And I don't know what happened in the last 2-3 years, but man, earnings have just taken off. So these are probably fairly priced. I wouldn't even classify them as overvalued. Now, would I chase this? No, I don't chase this. For my portfolio of global sector rotation, I missed it. I would have been in down here. I probably would have sold around here somewhere just to book some profits and not get greedy. I would have taken my 50% and been out. But it's crazy. IYT, transports, truck, rail, air for transporting people and goods, looks good. So that tells us that the economy is expected to grow. By the way, when the 13 is above the 50-day EMA, when the 13 EMA, red, is above the 50-day EMA, blue, it's a good sign that that stock is still going higher. And then once that 13 looks like it's going to start tightening up and tightening up and tightening up, and then finally is starting to cross, think about booking your profits and getting out. Now, this is a slower moving indicator. Okay, you can probably have lost half of your gains by then. So, but it is one indicator to watch. Okay, let's jump into some stocks. Let's see what we got here. 1 second. All right. Got a few more questions. Are you looking at hedging your Pinnacle strategy in the near future? No, that strategy is unique on its own. So we do not hedge Pinnacle. We just adjust through everything. So I do not carve out any percentage of the cash to open up hedges. Purely, it's a trading strategy, and we can navigate through anything. It's just when the market pulls back 10%, for example, we have a really deep correction, 10, 12% correction. We'll lose 30, 45 days, maybe even up to 60 days, but that's fine. I look at 12 months at a time. So I have 12 months to make my 25 to 35%. And I'll lose several months here and there with corrections, and we'll just adjust through it. All right, another question on the index, or on the index that we use for Pinnacle. We usually use the SPX. You can use the RUT, R-U-T. I used to use the RUT. Problem is that the powers to be over in New York, over the exchanges decided to eliminate competition, and only 2 exchanges trade the RUT, the RUT, that's the small caps. And you can see it in the bid-ask spreads, and it's harder to trade, and it's sad. It's sad not to have competition, and I can't believe they did that. So I started getting a little concerned about trading the RUT. So I just kind of been trading the SPX because of that. All right, one last thing on Iron Condor Pinnacle. Would you consider opening more put spreads or avoiding put spreads if you think that the market's starting to roll over? Well, actually, yes. So when you're opening Iron Condors or credit spreads, selling call spreads on the top, selling put spreads on the bottom, that is how you modulate risk. So if you start seeing a lot of indicators telling you that the market could be going lower, yes, you can underweight on the puts. Now, it's not wise to completely turn off the puts because you could be wrong, and the stock market's job is to really screw you up and do all of the things opposite of what you think it's going to do. So you just have to kind of underweight here and there and overweight here and there, but more often than not, the market does exactly the opposite of what you think it's going to do. Okay, let's look at some charts. So the first charts that I always look at in the morning is, all right, what's Tesla doing? What's Microsoft doing? What's Apple doing? Google, some of the other high flyers. I just care about sentiment, especially like when you're looking at Tesla. So here's Microsoft, because everyone and their grandma owns these stocks. And are they still grinding higher? And they represent a large percentage of the indexes. So between Microsoft, Apple, and Google and Amazon, sometimes they represent 40% of some of these indexes. And that's not good. It's hard because it just moves the index too much. It's just too reliant on just a handful of stocks, but it is what it is. We can see Microsoft's breaking out. They had really good earnings. Apple's breaking out. Wow, they're going higher. And they're not that expensive. They're only trading at like 35 times earnings, something like that. So could they go higher? Yeah, they could. I don't like chasing these. Now, I'll call it less chasing because it did consolidate. It did consolidate for a long time, for many months. So now it's breaking out above this consolidation level. So if I see a consolidation pattern like this, yes, I would feel more comfortable getting in and taking that next 5–10% up. But then I'm going to get out. It's more of a trade. I mean, yes, you could do it as an investment too if you wanted to. For these, you could. You can be like, hey, I see Apple, it just consolidated, it just did a cup and a handle, it based, it's breaking out. I think it's going higher, and I think the PE is going to stay at 35 times or 40 times. Well, okay, that's sure. We can discuss that and argue that, and I might agree with it. Okay, Amazon, same thing, long base. Facebook, long base. So could these break out and go higher? Yes. Just wait for them to break out exactly like this. Wait for Apple to break out, then get in. Microsoft's breaking out, now you can get in. I still feel a little uncomfortable because they are trading at 35 to 40 times earnings, getting a little expensive for these huge companies, but they are growing. They are still growing. It's pretty amazing. Tesla, I care about Tesla because of just sentiment. How crazy are people out there? And are they still willing to chase stuff? And Tesla, this is a weekly chart, by the way, so you can kind of see what it did. By the way, this is trading at 450 times forward, backward-looking earnings, and it's trading at about 200 times forward earnings. Is it expensive? Yes, it's very expensive. Do I chase this? No, I don't. Do I have some clients that are holding Tesla and still buying it? Yes. I don't argue with them. I'm just like, hey, it's expensive. Tesla's going to have to execute perfectly for the next 5 to 7 years in order to grow into the stock price. And they are making money now. I think they're going to generate $4 worth of earnings next year or this year for 2021. So it's impressive. They're making money, but it's still extremely expensive. I show Shopify because this is like one of 200 stocks that look like this. They're all like really overextended, overbought. Shopify also trades at like 450 times backward-looking earnings and maybe 200 times forward-looking earnings. People are still getting in. So it just tells me that, this uptrend's probably not over. Okay, ETFs. So here's some ETFs, EWZ Brazil, EWG Germany, EWU UK. Here's gaming and casinos, BJK. So let's find one right here, EWZ. Here's a nice setup here. See how I was up here, crashed, bounced. Here's one level. Also, you have to go look at the, you always have the weekly chart with your daily chart. I'm just showing the daily here. The weekly allows you to draw some horizontal lines that go way back. So, and then this one I probably just picked up from here. I wanted to, at least to get over this level, which it did. And I think this level was picked up way back. It's hitting resistance on it. That's a typical chart where, so you can see the 50 has crossed above the 200. That's good. The 13 is above the 50. That's good. And this chart's above this resistance level here. That's good. These are the types of charts you can get into. Now, I would call these contrarian. So we put these in our contrarian, but these are also called low risk entry points. Low risk entry points. That's what we focus on. Low risk entry points. Let's go back to Tesla. That right there is a high risk entry point. You might be able to make another 10 or 15%, but you could be down 50%. Risk reward trade-off. Always watch risk reward trade-off. This over here is a high risk entry point. So you can maybe make 5 to 10% on the upside, but you can lose 30, 40, 50% on the downside. That's a high risk entry point. This is a low risk entry point because it's already been stabilizing. The 200-day line is now upward sloping. 50 is up through the 200. It's been basing for many, many months. So you don't really want to get in down here. If you're a bottom fisher, you can get in, but you got to be careful. You can get burned on these. It finally bounced, went up, hit resistance. You wanted to go up and hit resistance twice or 3 times. It's basing, now it's breaking up. That is a low risk entry point with a high probability of success. Same thing with here. Identical chart. These are more of a breakout here, but not really. It isn't. This is a March 2018 high for BJK, but these are the types of charts that are lower risk charts to get into. So that's what we look at. We got scanners always spitting out these stocks. We got literally hundreds of stocks coming out, and then you just kind of have to look at them and then look at the fundamentals. Now these are ETFs, so it's hard to look at fundamentals for ETFs because they have 30, 40, 50, 60 stocks in them. So you're mostly relying on technicals when you're buying ETFs. Okay, let's do some stocks. Okay, back to these again. These are the types of stocks that go into our global sector rotation ETF. Okay, now none of these are in particular order. I just kind of pulled them out. These are mostly newer entries into our portfolios, either the big cap or the small cap, mid cap, sector rotation, contrarian, or opportunity one. Okay, Syneos Health. This is diagnostics and research. This is a fresh breakout. Okay, XLI Industrials. Now this is an ETF that would go into our global sector rotation ETF, but that was a fresh breakout. Now you can see it's testing. It's testing this breakout. That's okay. Don't freak out. You don't want to get out yet. Only if it starts breaking below that breakout, and you'll see it below that breakout for 2 or 3 or 4 days, then you might have to get out, because guess where it's going? Right back down here. Back down to the 200-day line, back down to this. Jets, this is more of a contrarian play. Identical chart to the ones I just showed you. You can see that the 50 crossed the 200 and it's finally up through this resistance level. So you can go long Jets. Now you have to be patient on this. I mean, the airlines have just been hammered, and be careful on the airlines. They can still go bankrupt. You know, UAL could go bankrupt, you know, Delta Airlines, American Airlines. I mean, who knows? We just don't know. I mean, they're just still struggling, and they're burning millions of dollars a day. That's why I like the ETF, because it has a bunch of airlines in it. So if someone goes bankrupt, I won't lose all my money. I'll just lose a little bit. Amcor, fresh breakout. Now this one's nice. You might want to take a look at this. I had this in one portfolio. It just took off immediately. I was up like 15% on it. It's pulled back hard. It could be giving you another opportunity to get in. This is an additional opportunity to get in, because if it stays over this breakout and bases on this breakout, that is a very good chart setup. Owens Corning, Building materials are still hot, breakout. Addis Home Health Care, breakout. So again, these are all low risk entry or lower risk entry points, because if it starts breaking below the breakout, it's coming down to the 200 usually, and that's usually when you want to get out or be careful. RRGB, this goes into the opportunity fund, including this one, Owens Corning. No, actually, that's not true. This one does. RRGB, restaurants, casinos, movie theaters, anyone that's still hammered from COVID, they all look like this. All the charts look identical. So we're just getting in on breakout, and then we'll cycle them, by the way. So it's a little bit of work. That's why if you don't have the time, let us do it for you, because we'll let this thing climb up to here and we'll get out right here, and then it'll pull back and retrace, usually 50%. We'll get back in, and then we'll let it climb, and then it usually will rubber band and shoot right over this level. So we'll get in 2 or 3 different times. UCTT, again, I kind of randomly grabbed these. These are newer entries into newer positions in most of our portfolios, whether it's a small cap or the sector rotation. This was now this is beautiful right here. I like it how it climbs up. This line goes back off of a weekly chart. And so that's the resistance level. And so it always does this. It goes up, hits, resistance drops, and then it kind of rubber bands and shoots over. So that's where you want to get in, right in here. Goldman Sachs, same thing. This could be a very nice entry point. It's kind of giving you another chance to get in. So take a look at that. ChemEd, they do home healthcare. Beacon Roofing. Actually, I have this one. This is one of the few that's not like a restaurant or something that's in opportunity, but it's people fixing their houses now once they feel like they got a little bit of money and COVID's passed, and they're like, okay, I need to put a new roof on my house. JP Morgan, this is always a good company. This is probably to come down to 119. But that's over this breakout here. I would consider picking that one up. I think I have that in a large cap. APAM, asset management, fresh breakout. Boyd Gaming, that's a fresh breakout. Now, by the way, we were in this twice already. So we were in when it got over here, and we made money in our contrarian up to here, maybe up to here, and then we got out, and then we waited for it to break out. Now this is a fresh trade. Vale, this is metals and minerals. This is giving you an opportunity to get back in. This is a high from August 2020. No, 2000, I can't read that. It goes way back. That's a high from a long time ago. Synaptics, fresh breakouts. Okay, let me just summarize these two, and then I'll jump into, we're already out of time, but whoever wants to hang out, I can still do the Pinnacle. Okay, so global sector rotation ETF. So it's a rules-based, it's an active strategy. That's the difference. So everything we do is active. So we look at it every day, watch all the charts every day, and then we're constantly in and out of things. If things are breaking down, we're out. We don't want to lose more than 5% on something, maybe 7%, but that's still okay. You just kept 93% of your money, and you can rotate it into something new. So we identify high probability bullish positions and ETFs, and we draw it from 90 industry sectors and country-specific indexes. So it's well diversified. So the foundation is based on the fact that institutional money rotates around the world, from sector to sector and around the globe. So we constantly monitor and rank the 90 industry sectors, and then we follow the money. We'll select the top 25 that have strong relative strength. So our objective is to generate excess returns above global stock market indices. This is a good substitute for a broad index, such as the SPY or any of the other broad indexes. So, if you want to talk more about it, you can email me, we can talk, and I can put on my QTR Capital hat because I can give investment advice. In general, the indexes are expensive. So you don't really want to be doing passive right now. I would be doing much more active. So active stock picking can work, and active ETF picking can work, but they have to be actively managed and watched closely. All right, opportunity strategy. Again, reminder what this one is. Some of the stocks that I showed you that had that more of that contrarian chart where it's just finally it's basing, it's been hammered really hard, and it's coming back. All the charts look the same in this one. So this is rules-based, actively managed. take advantage of the still depressed restaurant, retail, department stores, clothing manufacturers, hotels, casinos, travel, leisure. And one of these days we're going to be out. I mean, in 12 months, I won't have anything to pick from. So we're going to be making our 20, 30, 50, 70% on each of these stocks. We're out, and then I'll close the strategy down. I just say conservatively, we'll probably hit 50% over the next 12 months. We hold 25 stocks. We do manage it actively, and we'll cycle them. We'll get in, we'll get out, we'll get in, we'll get out on some of these. Okay, so I started with 400 candidate stocks, knocked it down to 80 stocks, do fundamental and technical scans, and then we got it down to 25. But I still have an 80 stock list that's in my pick list. That's my watch list, and I'm always watching those, and then I'm rotating anything that books nice gains. I think I've already had 4 or 5 I've gotten out of. I will then rotate that money out of these 25 into some of these 80s that are still on the sidelines. All right, let's just move on here. Okay, so summarizing everything I've covered, these are the questions that I asked at the very beginning. Let me see if I can answer these questions, and then you can hit me with some questions if you want. All right, the major indices have been taking out higher highs, but recently had a strong down day. Is this market going higher, or is a correction coming? Well, I think that was one of the first shots across the bow. Market's expensive. Whether you agree with me on that or not, it's about 22 and a half times forward earnings. That is not sustainable. But we need kind of that choppy behavior. And really, I'm not getting any exit signals. I am not seeing any exit signals because the Fed still has interest rates at 0. They're still buying bonds through quantitative easing, so that puts a floor into the market. We're coming out of a recession because COVID will be eradicated probably within 6 months to 9 months, or at least mostly eradicated. We'll probably be at herd immunity by July, August. So is there any reason for the market to really go into a recession or crash? No. Well, I don't know about a crash, but a recession, no. We're coming out of one. So will we have 10% corrections? Yeah, we could at any time. Yesterday, we were down almost 3% in one day. So because the market's overextended and overbought, could we have a 10%, 12%, 15% correction in the next month or two? Yeah, we could. It'll be scary. But will people buy that dip? Probably, yes. I think the dips will be bought pretty fast because earnings are growing. We were at 140 bucks worth of earnings. Now we're at 168 bucks worth of earnings for the S&P, and we're going to be at 175 bucks worth of earnings of the S&P probably in the next 6 months. So, yeah, there's no reason not to buy the dips right now. So keep your watch list open, or let us do it for you. And because it does take many hours a day of watching these strategies and watching all the pick lists and rotating money that's been making money. Stock just made 30, 40%. We book that gain, get out of it, move it into something else. How expensive is this market? I think it's expensive. Can it get more expensive? Well, it could. It could, yes. Crazy. We're at, could it get up to 23 and a half times earnings? Yeah, probably it could. Will I be scared with that? Yes. If this market continues to pull back, where will it find support? Here's the S&P 500 index, probably around right here, 3,600. Here's the 50-day EMA right here. Here's the 13. This is up to date as of today. We're sitting at 3787. 3,700 seems to be a nice level, and then I think we could come down to 3,600 if selling starts accelerating, but that's kind of one of the major breakout levels here. So we'll probably stay over that. What will be the best investment style for the first half of 2021? Buying indexes or ETFs passively? No, I don't recommend it. Stock picking, yes. Covered calls, yes, that could work, because if you have bigger companies that have, a lot of strike prices to select from for calls, I think a lot of things are going to start kind of banging up against resistance and not go much higher. Just make sure you understand the chart. You have to be a chart reader and understand where that chart is, where the support and resistance lines are, and before you start reading calls. But that could work. Dividend paying stocks. Yeah, just be a chart reader. Just know what that chart is telling you. And there are some companies that look like they're going higher. You know, could be an AT&T, for example. I'd have to look at the chart again, but I thought that I saw it basing where you're like, hey, you can actually generate a 5% dividend, and maybe that chart is telling you it's going higher versus lower or sideways for the next 12 months. Just make sure you understand the charts. Non-directional trading strategy, yes. Pinnacle, absolutely. It's highly optimum right now. We're probably generating 10% a month for another 2 or 3 or 4 months. Active trading, yes. Passive investing, no. Stay out of the indexes. Bargain hunting, yes, that's contrarian. Just make sure, like I showed those charts, make sure it's been basing, make sure the 50 is over the 200, make sure you got your horizontal support and resistance lines and it's broken over certain lines. Buy the breakouts, yes, that works. Should I sell some of my ETFs and stocks? If you're more passive, yes. You know, I got a client that has a lot in Tesla. Many clients that have a lot in Tesla. And, you know, my thought is you'll never time the top, you'll never time the bottom. You will never time the top and you will never time the bottom. Always be booking gains, be booking even in a quarter at a time, take 25% off. If you're not sure and you're looking at it, at least book 25 or 30%, especially if you got a nice big heavy gain on it. And if that thing has gone parabolic, a couple days later, even a week later, and if it's still up there, book another 30%. Now, don't kick yourself if it goes higher, because it could. It could. Don't worry about it. You made a lot of money, be happy with it, and never make any type of selling decisions based off of taxation. Never make selling decisions based off of tax consequences. It's nice to make money. And also we're at the beginning of the year, so you don't really have any excuses now because we're at the beginning of the year. Taxes don't kick, you don't pay taxes now until next year on it. Don't be afraid to book gains. Should I add short exposure hedges to my portfolio? Not yet. I just don't. Yesterday was that first shot across the bow. I'm starting to look at it. It's just I'm still not really getting any exit signals. What will outperform in 2021? Value, growth, defensive, technology, commodities, smalls, mids, large, emerging, Asia, Europe, Latin America. One option is, you can get a free trial of global sector rotation ETF, because that one kind of follows all of this. So Latin America's looking good, Europe's looking good, Asia's looking good, emerging markets looking good. I like smalls and mids. Large, they always work. You just have to be active on them. They have to be watched. Technology, for technology, yes, they're still growing, just don't chase. Do not chase these charts. You want low risk entry points versus high risk entry points. And I showed you on Tesla, you want to buy in that one, or Shopify, that is a high risk entry point. You're looking at risk reward, or risk, how much reward versus how much risk trade-off. So just don't chase these charts. It takes more work because you want to find those fresh breakouts. Should I buy bonds? No, interest rates are going higher. You can use really short duration or short maturity bonds, anything 3 months or less. That won't be impacted with interest rates going higher, but you're not gonna make much more than 2.5%. And there's plenty of ETFs that have those bonds in there. Provide overview. Okay, so all right, I'm ready to jump into Pinnacle. Let me see if there's any questions and who's left here. Well, it looks like everyone's still hanging in. I'm gonna do Pinnacle now. Let me answer a few more questions. All right, Roy was asking about technical analysis for Pinnacle. Do you use technical analysis on Pinnacle, or is it more about targets? Usually one thing that people will do, especially people just getting started with options, they'll look at delta. They'll look delta of the short leg that you're selling. And they'll say, okay, I'm only selling 10 delta of the short leg of the short call or the short put that I'm selling on the SPX. That's one thing you can look at. My deltas are a little higher these days. So I used to, do 10 deltas, 9s, 11s, and now I'm more in the 18s to 20s. So I'm bringing in more premium. but I also have to be prepared to move the positions more often. But yeah, I am using technical analysis. I'm using support and resistance. I'm looking at the charts very closely. I'm looking at behaviors of the candlesticks. But really support and resistance, once you kind of get you have a pulse on the overall market and you believe that, oh my gosh, we're grinding higher. We're going to be heading up to 3,900. I keep that in mind as I'm opening up my chart, opening up my call spreads. I want to make sure that I'm up high enough that I don't have to push the thing up too many times. It would be nice to be at a 38.80 or 38.70 or 38.65 if I think if this market's gonna grind up to 3,900. And you can kind of see it from looking at lots of different things. But you have to be prepared to move it because the index might get up there faster than you think, so you have to move it once or twice, and that's just part of the business. But yes, it's technical analysis is definitely a part of it. All right, Pinnacle is a conservative, non-directional income generating all-weather strategy. It's optimized, well, for the new political era. Well, maybe the new political era is over. But over the last 4 years, I had to adapt to that political era, that new political era, and I had to adapt to a Twitter feed that was moving the market constantly, and that made things pretty tough. I could sell stocks off at any time. This strategy is highly optimum when the market is sideways and choppy, but it can still make money in upward trending and downward trending markets. It's just, if it's a melt up, it's hard. We're not going to make a lot of money if things are just melting up, because we're sliding these trades up and making all kinds of adjustments. But when things get a little more choppy and bouncy and all over the place, or choppy and toppy, that's beautiful for this strategy, especially when volatility is higher. We hold a maximum of 3 to 4 positions, and this is the main thing I did to adapt to the new political era. I used to be running at 5, 6, 7 positions, meaning 70% of the money was put to work. And I'm now at 3 to 4 positions, or 30 to 40% of exposure, basically. So hypothetically, a $10,000 account, I might have $3,000 or $4,000 put to work. The rest is cash, and I need that cash. And I'm still bringing in very chunky premium, so every time I open up one trade, I'm adding sometimes 3% for the whole portfolio. So one trade I can have 2.5 to 3% for a $10,000 portfolio. That trade's only open for a week or two. So you can see that I can get up to a 5, 6, 7, 8% for a month pretty quickly. It's just the market needs to behave, because if it just starts bouncing around, then I won't make too much money that month. But it's okay. I have 12 months to do it. So each position represents 10% of the portfolio. It's usually open for 2 weeks. Recently, they're open for 1 week because of the higher volatility. And that's beautiful. We hold enough cash in the accounts to make trade adjustments when volatility unexpectedly rises. So again, we're usually at 30 to 40% allocation of the portfolio. We have plenty of cash, and that's what we need when we're making adjustments. So the strategy is conservative by construction, allows us to sleep well at night, because we have a low level exposure, but we're still able to generate some pretty nice monthly gains. Targeted returns under steady state are 3 to 5% per month. Right now it's higher. It's more like 6 to 10% per month. And we'll see how long it lasts. And then it'll probably come back down, steady state, back down to normal. We'll probably be in that 4 to 5 to 6% per month. But not every month is going to be a positive month. We will have some losing months, and we can usually keep them pretty tight. -2s, -3s, -5s, and then I can make that back pretty quickly the following month. The returns, again, will be closer to 5 to 8 per month due to elevated volatility. Capital preservation and safety are a top priority, and then we got about 17, 18 years of experience with this strategy and optimizing it. Okay. Recent Pinnacle trades, so let me just talk about a trade. All right, so this is a risk reward graph. It has 2 parts, the right and left. Let me just show the left part first. This is an old trade, but it's just good for illustration purpose here. So this is the SPX. And for this snapshot, the SPX is kind of in the 29.50 range. The blue line is where it closed as of this date where it closed at 29.51, and it was kind of in the October timeframe. Okay, so the SPX is bouncing, going up and down, and this is where it closed, 29.50, 29.50.98 on October 1st. And then on the right side is the trade that we're going to open up. So we're going to sell a call up here around, here's the call that we sold. We're going to sell the 3010 call, and we're going to buy the 3020 call for protection. And this creates this chart. So 3010 call here, 3020 call we sold. I'm sorry, we bought for protection. Oh, let me just explain this first. This is the risk reward graph showing the profit of a trade. So we have the horizontal line here, $0. Anything over in the right side of this graph represents profit for the overall trade. This trade has 4 legs, 4 option legs. So if we're over here, we can make $200, $400, $600. It represents a single trade, quantity 1, that holds $1,000 from the broker. So the broker is going to hold $1,000. You're allowed to open up this trade. $1,000 of maintenance is held, and this trade has the potential to make $400. Okay. Now this trade could lose up to $600. See, I brought in $400 of premium when I first opened this trade. Broker holds $1,000, so really I have $600 at risk. This is a credit trade. I'm bringing in credit. So I'm selling a call, I'm selling a put, I bring money into my account. In this case, I brought in $400. Broker holds $1,000 for maintenance. I think it was margin maintenance. My risk is really $600 because $400 came in, broker's holding $1,000, my risk is $600. I want the SPX to stay in this range. I want it to stay below this short call that I wrote, and I want it to stay above the short put that I wrote. And as a function of time, this is kind of your profit loss. This is the profit loss. Anything to the right's profit, anything to the left is loss. So right when I open the trade, and I have 14 days left on the trade, so it's basically a 2-week trade, I'm on the red line. All right, so wherever this SPX lands on the end of that day, you come across to the red line, then you drop down and you're like, oh, okay, I just made $80. My trade is up $80. And then as time progresses, you can see that the line is moving over to the right. So when you're 5 days out, you're on this deep green line, which is this one. And let's say the SPX is still bouncing around and it closed here one day. You come over to that line, drop down. Oh, okay, my trade's worth $200. I have $200 of profit. And then on expiration, you're on this black straight line. That's expiration. And that's that's the day you care about, because you want to make sure the SPX expires below this point, your short call, and above this point, the short put. And the potential is, if it does, SPX closes that final day, then you just made $400 on the trade. So you keep the $400 of premium that you initially brought in when you opened the trade. That money is not yours until expiration. And we had 14 days to wait. Then if we have to make an adjustment, let's say this SPX starts grinding higher and grinding higher. Now we're way up here, okay? If we're up here and we just opened the trade, let's say it popped up really hard in the first couple of days, you come across, maybe go to the blue line, you can see your trade's losing money really fast. So you need time to progress where the trade starts making money, as long as the SPX stays below here. If it starts putting pressure on this call, you got to move all this up. So those are called adjustments. So we'll push that call up 10 or 20 points. The one that we sold, we push this one up also. And we might slide the put up also. So we'll slide the put up to help pay for this adjustment. The adjustment's not free. So you have to that's where kind of experience comes in, where you're trying to make the cost of that adjustment as cheap as possible. So, or you might actually open up a brand new trade. See, I keep low portfolio exposure for a reason, because I might have to open new trades, bring in more premium to pay for these adjustments. And that's just temporary. I might pop it up to 50, 60, or 70% allocation for a week or 2 or 3 to pay for my adjustments. But my goal is to get it right back down to 30 or 40% allocation again. Okay, so, and this is what the trade looks like. It's the 3010 call that I sold, and then I bought the 3020 call. I sold the 28.55 put, that's this point here, and then I bought the 28.45 put, that's this point here. And that's called an Iron Condor, and it was good for 2 weeks. And this is the risk reward graph. Okay, and this is just a bigger picture of it, and that is an Iron Condor. If you decide not to do the put spread, then it's just going to have the top part, and this is called the bear call spread. And it basically allows you to just sell a call and buy a call, and then you don't have anything down here. So that's just called a bear call spread. Or if you do the other way around, I'm just going to basically sell a put and buy a put, then it looks like this. Just the bottom part, the top part doesn't exist. And we'll many times leg in. If we have a really, really strong up day, and if I feel comfortable up there, I'll sell a call, I won't sell a put on that day. If we have a super heavy, heavy down day, yesterday I was tempted to open up a put. I could have opened up one way low, way down at like 3,600. I decided not to do it. I already had some exposure, and I'm like, I'm not going to do it because, you know, we could go a lot lower because this market's expensive. So I'm pretty conservative in opening too many trades. Okay, so this is the S&P 500 index. This is the fresh chart as of today, and you can see that when we open up 1 or 2 week trades, we want to write them up here around 3,900 or 3,880. And then we'll write them down here around 3,700. If you can get it below the 50-day line, that's good. That's helpful. And, you know, you just want to kind of, you know, just keep on keeping it centered, and then you move it as required. All right, this kind of summarizes the trade. So this was an October 11, so it's like basically a 2 week in duration trade. We sold the 29.55.45 bull put spread. So it was the 29.55, 29.45 puts that we sold this one, bought this one for protection. It's called a bull put spread. Then we added the same strikes or the same expiration date, the 3010, 3020 bear call spread. We call it a bear call spread because we want to be bearish. We want the SPX to stay below this point. For this one, we call it a bull put spread because we want the index to stay above this point. So we call it a bear call spread, a bull put spread. We add them together, you get an Iron Condor. For this particular trade, now this one, this chart was wrong. I think for some reason the chart was giving me the wrong graph, but it brought in 130 bucks for the put spread, or $1.30, and brought in $1.70 for the call spread. You add those two together, we got a credit of $3 or $300 for a quantity one. Again, we opened up a quantity one, just one contract, one Iron Condor. Broker held $1,000. For this trade, the real trade was we brought in $300, not 400. That's too high. We brought $300 in, and the return on the trade was a 43% ROI in 2 weeks because we risked $700 and we brought in $300 of credit. For a $10,000 portfolio, 300 divided by 10,000 is 3%. So we brought in 3% return in 2 weeks. Not bad, huh? All right. Now I got one question on deltas. So the deltas, my deltas tend to be closer to 18 to 21. That's much higher than they used to be, but I feel very comfortable in swaying and moving with the market, and that's how you can extract delta out of this market. So 30% of my trades I'm moving, and that's perfectly fine. So, and I only have 3 trades. So each trade is open for a week. Usually they're open for 2 weeks. I watch them very closely, and then I'm constantly moving them when I need to move them. And so when I'm bringing in a typical Iron Condor right now with higher volatility, I'm bringing in $300 for a quantity one. If you're doing quantity 10, meaning that's a $100,000 account, I brought one trade in, brings in $3,000. And then we do a pretty good job of keeping that money. It takes about a week to keep it. If I don't have to make any adjustments, we keep the 3,000. and we do it again. But now I do that 2 or 3 times. So if I have 3 fresh trades I open up, and that's a quantity 10, that's going to be, I'll bring in 3K, 3K, 3K. So I bring in $9,000 for a $100,000 account. And then in about a week, week and a half, 2 weeks, we keep all that money and then we do it again. So rinse and repeat, rinse and repeat. So on the deltas, delta is just one piece of data. I don't really focus on the deltas. I focus more on support and resistance on the charts. And kind of, if I'm writing a call, I just want to make sure I don't have to push it up too many times, because if I know that we're starting to break up through 3850, 3870, or yeah, like the target's 3900 for the SPX. It's like I really want an up day so I can open up the call a little higher, at least above 3850, like 3860 or 3865 or 3870, because I might have to push that one up a couple times. And if I have to push it up more than once or twice, it's a lot of work. I just would prefer not to have to keep on, and then I lose time, because I have to trade that. I can't keep that money. I have to keep on pushing it up. So I will kind of pause, and if I think we're grinding up to higher and looking at lots of different things, I covered a lot of that in this presentation of what I'm looking at, then I'll kind of wait for an update, then I'll be like, oh, okay, I can open up the 3870 call. I can bring in $1.50 on it. I'll open it. I might have to move it once, but that's fine. All right, so for drawdowns, now that's one thing that you have to, all strategies have pros and cons. There's no free lunch. If you want to make 25 to 35% a year on this type of strategy, and sometimes I can do better. Last year it was 40, 42. We will have temporary drawdowns. So let's say we have a fresh account, $10,000 account, and we open up one Iron Condor. So basically 10% of the account is used, $1,000. Broker holds $1,000. I open up the Iron Condor, I bring in $300. Let's say we have a 10% correction immediately. My put just went in the money. I'm gonna spend, and let's say it's a nasty correction, I'm gonna spend 30 days adjusting that trade. Maybe 20, maybe 15 if I'm lucky. If I can get out of that trade in 10 days, I'm doing pretty well, because that was a pretty nasty 10% correction or 15% correction. That $1,000 will draw down. About 80% of that trade will draw down. So of a $10,000 account, you can have about an 8% drawdown with that one trade. I call it a temporary drawdown. It's not a loss. It's not a loss unless you book it. If you want to get out, get out of that trade and you have an emergency and you need your cash the following day, yes, you have to book that loss and you have to exit out of that trade. So that trade is basically has an 80% drawdown on it for that one trade. So a $10,000 account, one trade, that's $1,000 for one trade. $800 of that is drawn down. Okay, so $800 for a $10,000 account, that's about 8%. So you can see how you get drawdowns on a credit spread. In this case, the put spread got hit and went in the money because we just had a 10, 12, 15% correction. Those are temporary drawdowns. We can get through it, no problem. It just takes time. It will take a week or 2 weeks or 3 weeks, and then at the same time, I'm opening up more exposure. Let's say I'm like, ooh, I'm way down there. I don't think it's going lower, and after 2, 3, 4 days, the market's stabilizing, market's bottoming. I can still open up something way down there and I can bring in $1.50. I will open that up, because that's it's almost like free money in my book. It has very low probabilities of getting hit because we watch a lot of stuff. So that's kind of what's going on with that. Okay, I'm going to have to wrap up here in like just a few minutes, and I appreciate you guys sticking around for this very long presentation, because we're like 30 minutes over. If you need me, I'll show you my contact information. You can just contact me, but you can see the high returns for one trade, and if we do it 3 times, that means 30% of the account is allocated for a $10,000 account. We just brought in maybe 5 of those trades in 1 month. We just brought in 5 35 to 45% returns in 1 month. You can see that stuff adds up. So it's right now, it's really nice. It's highly optimum right now. Okay, so those are the returns. You'll see this on the upsideoptions.net website. And yeah, consider trying Pinnacle for free. We have free 20-day trials. We recommend to auto trade this strategy. If you want to learn it, you can just do it in parallel. Just shadow it, have your own account, put a small amount in there. But if you got a bigger chunk and you want to make money in it, make sure you auto trade it, because this is a faster moving strategy now. 10 years ago, you could self-manage it. You can't anymore. I mean, it's much more difficult to self-manage this strategy now, because we're opening and closing stuff quite a bit. Those are the strategies there. It's all on the website. For our clients that are greater than 100K in any particular strategy, we'll ask them to move them over to QTR Capital, which is a licensed and registered firm. And that's it. Okay, so I'm not sure if we have any more questions, but I think we're just way over. So send me an email, support@upsideoptions.net. I'm Brad Renard. I'm the chief publisher for this company. And thank you very much for your time. And I'll see you next time. Thank you for sticking around. Bye-bye.